Hey everyone, happy Thursday, August 29th. It's a little after 10 a.m. on the West Coast, and it's time for another market update. So, with the next Fed meeting scheduled middle of September and the expected rate cut, going to happen then, the markets have been, kind of holding their breath until that point. A lot of, sideways movement, which is not a bad thing. We've had a lot of gains over the last month or so it's nice to hold on those gains. But there was some important data that came out this week, so let's get right into it. Going back to last Friday was the Jackson Hole Symposium. This is when all the central bakers from around the world, or at least the important ones, I guess, come together in the United States in Jackson Hole, Wyoming, and have their little get together. On Friday, our Fed Chair Powell gave a speech. And the main quote everybody was running with is that the time has come for the Fed to cut rates. So the markets like that talk. And again, listen to all the other speakers. It's a matter of, are we going to cut maybe a quarter point in September? Or are we going to cut a half a point? And that's really the big debate and what the markets are kind of trying to digest over the last couple of weeks and probably going up until that date on September 18th. So overall, good what he said. He could have scared the markets with some very, hawkish talk, but overall, that was well received. Next thing we got some home appreciation numbers. So for June for the Case-Shiller and the FHFA, keep in mind Case-Shiller includes everything where FHFA does not include cash deals and jumbo deals. So if FHFA tends to be a little bit lower price homes. Month over month in June, remember this is a little bit more dated compared to a lot of data. June was up 0.2%, is now up 5.4% year over year. And the FHA was down a little bit, negative 0.1%, and it's up 5.1% year over year. Overall, still very, very strong gains. Looking at this in graph form, the Case-Shiller at least, you can see, the 10 city was up actually 7.4%, but you can see we've had, a slowdown in appreciation, not a depreciation, but actually a slowdown in appreciation over the last couple of months. So you see dip a little bit because they've been running so hot. One thing I did want to mention, I believe the 10 city, the lowest city on there, I believe, was Portland, just a 0.8% growth. So for us here in the Pacific Northwest, that was something to keep an eye on. But overall, again, good for current homeowners. Our homes continue to appreciate no matter what, people said a couple years ago about, we'd see home prices fall by 5, 10, 20%. A lot of doomers out there. Next thing we got, July pending home sales. This came in. Their index came in down negative 5.5%. It was expected to come in at up 0.1%. It's now down 8.5% year over year. I believe this is the lowest number NAR has shown since 2001. So it's started tracking this data. So overall, a pretty bad month for pending home sales. Really slow. My theory, at least, obviously rates have been high and they're coming down, but there's also all this talk about, there's going to be a rate cut in September. So I think a lot of, maybe homeowners, if I was hearing that, even though, there's reasons not to wait, mainly a lot more demand will happen in September and you're probably going to pay more for the home. But maybe that's keeping people from going to contracts saying, hey, I'm just going to wait till this rate cut. I want to get a better rate. That kind of incorrect thought process. But overall, not a good number. After a good number in June, I think it was up like 4.8%. So again, this is the month over month, but yeah, year over year down 8.5% compared to last year. Q2 or quarter two, the GDP for the United States, the second estimate came in at 3%, up 3%, which was higher than the estimate. The first estimate was 2.8%. The main thing that made this jump a little bit was consumer spending. Again, Americans seem to be spending a lot of money still, so that made this jump. But the one positive that came out of this, there's a quarterly kind of PCE inflation report, which we're going to get tomorrow. Kind of get an early look at the numbers there, and those beat expectations by a little bit. I think the headline was down to 2.5 compared to 2.6 expected. I believe the core was 2.8 versus 2.9. So that's a good thing. We'll talk about that in a second, but we got a big PCE report tomorrow, so that was good to see. Initial jobless claims. This is important. Again, the Fed's paying really close attention to the labor market. The weaker the labor market looks, probably the better chance we're going to get, more cuts to that rate, which we, on our side of things, we want. That was expected about 232,000 new claims, came at 231,000. So still pretty low levels, nothing too crazy. Again, we don't want people to lose their jobs, but it's something to keep an eye on just because we know the Fed is keeping an eye on this. So where does that leave us? The average 30-year conventional is down to 6.41. Last week is at 6.48. So a nice little drop, not too much, but like I said, we kept our gains and got a little bit more. So this is the last year. We're looking at the average 30-year conventional for top end borrowers according to this lender survey on Mortgage News Daily over the last 365 days. So the high point I think was 8.03 here. The low was not too long ago at 7.34. So we're pushing up against that 7.41. But you can kind of see all the ups and downs we've had over the last year. So it's good to see, it's getting near these lower levels. And with these Fed rate cuts on the horizon, maybe that means we're going to get even lower, which is the expectation. So important dates coming up. We got the PCE big inflation report, the Fed's favorite form of inflation tomorrow. That's coming out. Hopefully that runs with the GDP estimate and comes in line with estimates or better. That would be good for more rate cuts. Anything that comes in hotter than expected is not good. Then the week after that, we get BLS Jobs Report. This is a huge one. The higher unemployment is, the weaker this job reports look, just the better chance we're going to get, maybe a 50, a half a point cut here in September. Then we got a CPI report on September 11th. So overall, good to see, like I said, rates held on the gains that we had. Everybody's kind of waiting for that September, rate cut to see what happens. And really, it's going to be about expectations. When that date comes on September 18th, if the market's going into that date are expecting a quarter point cut, we get a quarter point cut. Probably no big deal. Market's already baking that in. If we get a half point cut, market's going to rally. That's going to be a good thing. Maybe that conventional rate pushes down, close to that 6 number. But if we expect that the markets get really excited, if everybody gets excited and thinks, they're going to do a 50-point cut and they only do a quarter point cut, that's when we actually could see things step back a little bit. Since the markets aren't waiting for this to happen, they're starting to build on the narrative and build it in. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, and let's hope for a good PCE number tomorrow. Thanks, guys.